All right, ladies and gentlemen, and welcome back to the latest edition of the EFG or Emerald Financial Group podcast. I'm here with my good friend, my good colleague, Karo Cornips. Karo, thanks for joining us in this one.
Thank you very much, Samuel. It's been a while. It's been a hot minute since I've been on.
It has been.
I was worried for a moment that I wasn't going to be invited back, even though we sit next to each other and talk about this stuff all the time.
Absolutely. Well, everyone's clambering to get on the podcast, so lucky enough to have us both on today.
I helped build this podcast.
I mean, we all did, to be fair.
I know.
Yeah.
But no, it's good to be back. What we're going to talk about today, we're going to try and cover what's been going on in the market recently.
Yep, absolutely. And, using some technical analysis to maybe see if this is the top of things, if, we've had this run up now, if that means we're about to roll over, and we'll go from there. Might I say you're looking pretty swish today, Karo? You've got the blazer on with the lapel pin, no less.
Yeah, it's a little honeybee because we should all be aware of the bees, I suppose. Mm-hmm. And the birds as well. Mm-hmm. But Sammy's always got to make a comment about what I'm wearing. You yourself look like you haven't grown past the age of 12. Did your mum still fix out your clothes?
I like this jumper.
No,
it's still winter here in Melbourne, I might add.
It's retro. Yeah. I actually do like it, in fairness. I think a bit of technical analysis. Mm-hmm. That's what I like to do anyway. You could talk about the fundamentals, I suppose. Technically speaking, the market ran up pretty hard. I've been saying this for 2 weeks now. Maybe not exactly 2 weeks. But if you took the acceleration of the recent trend, right?
So we're looking at the chart of the XJO here, everyone, which is the top 200 share index here in Australia.
Yep. As Sam likes to put it, the top 200 weighted by market capitalization. You can see that acceleration. If I draw that acceleration there, you might wonder why I'm calling it an acceleration is because you should draw it from the bottom here, and you try not to go through too much price data. And if you draw it through the bottom there, you can see that it accelerated off that underlying one there. But if you don't know what I just said, that doesn't matter. The point is this line, you can see that we don't really like to travel for too much longer than what we already did. Even throughout this period here, as we approached our all-time highs, we still had a pullback, right? We still had a pullback before continuing higher, and then before the dump, obviously. You have to go just the steepness of this run and the length of it was just unsustainable, right? So when we talk about the market, it's important that we establish a time frame, right? I usually don't like to get this serious, but I think it's important to understand that ultimately, if we're saying we think the market's overdone, it's important to clarify, are we talking in the immediate future or are we talking in the medium term or are we talking in the far future? Like what kind of investment horizon are we talking about? I think in this scope, it's fair to say that I was just talking in the short term, right? So in the short term, that type of bull run is just not sustainable. And this type of profit taking was completely necessary, even just for a healthy trend, right? Just to make it even sustainable. You can see that the stochastics for ages were just in that overbought area. And I know I'm kind of talking your ear off here, Sammy, but right. Overbought for a long, long time. And look how quickly the stochastics went back to some kind of normality, even just after 2 days, maybe 3, if you want to call it that, of bearish movement. But in the medium term, I think the market's at equilibrium. Yeah,
absolutely. And I think, just to interject, you didn't say anything I wouldn't have, so I didn't jump in.
Did I pass your
passed
test?
the test.
Oh, jeez.
But you're right, equilibrium, and I think that's illustrated by the fact that it's returned to the 200-day moving average.
Yeah, so again, if you're switching timeframes, those 200, 100-day moving averages are good for that medium-term outlook because it covers that 6 to 12-month view, perhaps. I mean, maybe it doesn't have to be even that long. And the market tends to return to them over time.
Yeah.
So you can see every time it gets away from it, they do return eventually. This time we spent a great deal of time there, but we actually got there pretty aggressively. Once I think we moved past the interest rate stuff, once they abandoned forward guidance in the Fed, I think the market was like, all right, let's get back to some kind of normality, the 100 and 200. Let's chill there for a moment. But in the short term, we needed to see that kind of, that let off of steam,
Yeah, absolutely. So I think, the 200, a good measure of the average price of the last, well, in this case, 200 days. And so a good measure of going back to the middle of the range.
Yep, and 100 as well, right?
And the 100
right
as well.
there. Yep.
But I think, from a sort of a cyclical market move perspective, the 200 is more closely watched. The market is now closer to its all-time high from the start of this year than it is to the recent lows from June, believe it or not. The market is now roughly about 8% from its all-time highs at the start of the year and about 12% from its June lows. So closer to the top than the bottom of the recent range. And fundamentally, I think the market's really gotten ahead of itself in that regard.
Oh, really?
Absolutely. So
Really? So what do you mean?
I think a lot of this move is basically the market saying inflation expectations have peaked, bond yield expectations have peaked, and that we will see a petering out, maybe a lower terminal interest rate from here, and that inflation will soon be under control and start coming down. And I think the market's just got that completely wrong. And I think maybe we've seen a sort of peak to those expectations, but I don't think it's just going to come down rapidly from here. I think German producer prices on Friday last week sort of illustrated that. I think that's a big reason why, in addition to these technical reasons, why we've seen selling across the past two sessions. And I think that when the Fed comes out tomorrow night from their Jackson Hole Symposium, they're going to tell everyone, we're not changing tune, we're not changing tone, we're going to keep lifting interest rates. I don't care what you're all predicting, we're going to keep going at it.
He's a madman. He can't be stopped.
Yeah. And I think that other financial markets have started to reflect that. You look at the currency markets, the US dollar's right back up. You look at the commodity markets, oil's coming back up. You look at the bond markets, yields are starting to rise back up. The only one who hasn't got the memo yet is the stock market. And I worry that, we will get the memo in the coming weeks and, we're going to rush to catch up in some regards.
So just to boil all that down, in the short term, you're not necessarily that bearish, but in the medium term, you think there's a good chance this market could roll over?
Yeah, absolutely. I think the risk is definitely to the downside. We said
I agree with
closer to the all-time high than the low. Well,
Yep.
I think we're more likely to return to the low than
Yep.
we are the all-time high.
Yep.
And, we've seen that trend line break. Doesn't necessarily mean the trend's broken. And you're right, could be a bit more in it. We could be seeing a higher trough here. It is a little bit hard to say where you'd say
I
the
agree.
previous trough was. But this is definitely a trough. And I think we're going to need to wait and see whether it is a higher or a lower trough, really.
Yeah, I know what you mean. I think that we're in for more stagnation.
Mm-hmm.
Our market is led by the US, no ifs or buts.
Yep.
And the US, very typical American cowboy. They're very positive, very self-confident, and where they love bull markets, you know what I mean? Australian have like tall poppy syndrome, we're more cynical, jaded. And I think our market's more likely to kind of, I'll give you an example of that. Even just over this period here, right? The US managed to get to its 200, and we pretty much did as well. But we couldn't commit to their rally because we were just too cynical about it.
But similarly, our last couple of days have been more bullish than the US last couple of sessions.
I don't disagree. Our falls, I don't think were as hard either.
No, the falls weren't as hard.
And this is what I mean. I think we're just more likely to drift between, let's call it 68 to 74. Mm-hmm. I know that's a huge range. It's a 600-point range. But you mentioned earlier, you're more likely to see the bottom, the recent lows, say back down at, whatever that is, 65, 64 or whatever, as opposed to seeing the highs at 78 or whatever it is, right?
Yep.
I think what's more likely than that is that we just drift side for ages, right? Eventually you're going to be right or you're going to be completely wrong. It's going to be one of those two things, right? You're either going to see 64 or you're going to see the all-time high eventually. But eventually it could be years.
Yeah, well, of course.
It probably won't be, but my point is that I just think we're likely to drift.
Yeah, no, fair enough. This is an uncertain market. There's a diversity of views out there at the moment. If we do have a look at the US market, you can see it's largely mirrored our own, or should I say we're mirroring it.
Yeah, exactly.
It's had that short-term uptrend, but they more clearly are still in a longer-term downtrend. And we can see that there on the
Yep.
chart. That came in right at their peak. It came in right at the 200-day moving average. And to me, they look a bit more bearish.
Yeah, I agree.
Yeah, I don't think we've seen the end of volatility. I don't think we're about to move into a sideways phase, but happy to
I'm not too
be
committed.
proven wrong.
I'm not too committed. I think you're going to need some fundamental development in these areas that have been dominating the market for such a long time in order to shift markets. Because again, we're at equilibrium, 200 and 100. I just don't think we're going to move too far away from that until something comes out. GDP data, no, not even GDP data, just some kind of build-up of economic data, bond market, interest rate, monetary policy, JPOW. Because we've had a string of that data over a while, right? And it's led to this. You're going to need to see probably a string more of it,
Yep.
possibly. But you and I both know we could just wake up one morning and the markets decided to skyrocket, or more often it'd probably dump, right?
Yeah.
So it can,
And
it can go either way.
I think in that sort of that possibility is increased in likelihood. I think that possibility of waking up and the US has had a 3, 4, 5% fall and we're opening 100 points lower. I think that's increased in possibility across the past sort of month or so.
Well, things as the volatility creeps out of this market, I mean, you can always. This is a bit, I don't know, tautological maybe. I don't know, but it's kind of like, well, you can always look at the VIX, and when the VIX goes to bed, there's usually that kind of spike, right? This kind of reflects the market, so it's kind of just confirming what things might be already telling you, but when the VIX goes down, down, and down, then you usually get those kind of spikes. And we're at that again, right? We're at that stage where the volatility has kind of fallen off so much that in that kind of environment where a spike in vol, which is usually led by a big fall in the market, is you're in that kind of environment. It might be on its way.
Yep.
But the problem is that being forecasting and predicting like that is you could be a month off.
If you're looking at technical factors purely. If you're purely looking at lows on the VIX, absolutely. If we go back to, late 2021, there were...
On the VIX?
Yeah, yep. Let's just scroll out a bit. There were months on end there where it would just remain low. And that coincided with the market just creeping higher and higher.
You'd still have those spikes though, right?
You'd still have those spikes, absolutely.
Big bumps up.
If we look around, October, November, December,
throughout this period,
there's 3 months there of very, very,
very high
little
volatility.
movement. Oh no, I was going to say before the big spike.
Oh, this one
in December.
here?
Yeah.
Yeah, but I mean, how long is that? What, a month or two? And this is what I'm saying. You could be a month out.
2-3 months.
Perhaps we're agreeing. rather than disagreeing.
I think we are agreeing, but I think if you're purely relying on the technical factor here, you're not going to get the exact timing. I mean,
no,
it's
I
impossible.
100% agree. But then, okay, if that's the case, then what do you look at? Fundamentals?
Yeah, you look at key fundamental events. You look.
There's been so many of them.
Key data releases, absolutely. And I think several of these big spikes would coincide with things like a couple of CPI readings that came out that were bigger than expected.
Yeah, that's fair enough.
We saw the German PPI on Friday, which caused this recent spike here.
Perhaps, yeah. That was a big number.
Mm-hmm. Yep, 37% year on year, I want to say.
Which is nuts.
Uh-huh.
But you had a slew of PMI data. So you don't know what... It's probably going to be CPI data, let's be honest.
It will be price data.
It'll just be price data.
And to be honest, I think already other financial markets are starting to respond to that price data. It's just the stock market has been willing to keep its head in the sand a little bit, across the past couple of weeks. Bond yields are starting to push right back up. Similar thing at the start of the year, bond yields were pushing up and the market wasn't paying too much attention until all of a sudden...
Yeah, then it did.
It decided it was the only thing.
Yeah,
and
that's
again,
right.
Getting the timing right can be a bit difficult. Everyone will be watching JPOW on Friday. But I do think there's a lot of risk to the downside on this market. I think that if they really do want to get the inflation under control, they're going to have to do a lot of economic damage and
sacrifice. Yeah, I mean, do you want to get? I don't know if we should get political about it, but it's super interesting, isn't it? That the way that they're going to tackle inflation is by letting people die, as opposed to implement perhaps better regulation. And I said that. And if you want to fight me about that, then you can leave a comment about that.
Look, ultimately, I think we're entering a really difficult economic period where...
For who, though?
For the world, where I think a lot of our economic problems moving forwards are going to be the fact that we've taken the resources of the earth for granted. We've just exhausted them as rapidly as we could. And at the same time, we've dramatically increased quantities of money and things like that. And now we're going into a period where all that money is still there, but all those resources aren't. And
I think that's a really interesting way to put it, because that's like a economics 101 kind of, if there's one bread and 10 people, you know, that kind of scenario.
Yeah, look, I'm not a big quantity of money guy, because I think that the relationship is a lot longer, more drawn out and complicated than everyone who looks at the US dollars printed last year and goes, well, that's why there's inflation. I think it's way more complicated than that. But
well, I think that, again, you know, you say that we're heading into a bad period for economics, but it's only really for one type of people though, right? You know, it's only for the middle class doesn't exist anymore. It's perhaps more for the disenfranchised, right? So we see that a lot of things are crumbling as the wealth disparity increases, and these stock market crashes that, you know, I think when we were growing up where the business cycle was 10 years, and now that's becoming shorter. Like, you know, things are becoming more tumultuous economically, and, you know, that's a huge wealth disparity creator, right? That widens the gap even further. And I think that feels like the only people who are getting punished are the bulk of society, which is the middle class.
Oh, yeah. Look, I mean, yes, it definitely has increased inequality, but I don't think anyone will be protected from the issues that we'll be facing in the period ahead. You know, you look at, for example, the wealthy people in Ukraine, they've suffered just like, you know, maybe not to the same degree, obviously, but they've also suffered
due to war
invasion.
or because
due to war. But
right.
I see that as a war of resources. I mean, all wars are,
right,
but quite more specifically, I think,
right,
due to.
So if therefore, if you're talking about economic issues ahead, you're saying that means war?
I think they will lead to war. Yeah, absolutely.
Okay.
And yeah, that's one of the things that we're first seeing shortages of, a lack of supply of, is oil, for a few reasons, but also because a lot of the easy oil has, you know, now been drained. And we're seeing that with Saudi Arabia not as easily able to ramp up their production as they have once been. And I think really this invasion of Ukraine is about Crimean oil more than anything else. And those wars of resources, I mean, technically all wars are about resources, but those wars of commodities, I guess, and probably water will be much more frequent in future, I think.
Yeah, okay.
And, you know, we're running out of oil. We're also going to run out of, I believe, easy access to copper in the next sort of 10 to 20 years. A lot of those base metals, you know, the mine grade's dropping substantially.
We're getting more, like the counter argument would be that we're getting more efficient and we're getting exponentially efficient, or we were at one point anyway, and technologically as well. And there's been similar comments made by every generation for the past, 100 years or 200 years or 1,000 years. Everyone's always said that. And we've always managed to try and avoid that I shouldn't say always, but I guess we're trying to, stop that, this idea of water, food and stuff like that. We've been like, they were heading towards starvation, and then some guy figured out a way how to increase the yield by adding nitrogen or something. Yep. Energy crises may be solved, water crises may be solved. Yep. These types of things may be solved.
Absolutely. There are definitely solutions to a lot of these problems. You know, there's alternatives for oil. There will be alternatives to copper. There are other conductive metals and things like that. But it's not always an easy transition. It's not always a smooth period.
Well, we're going through friction right now, aren't we?
Yeah, and I'm saying I think this is just the beginning. I mean, I think this oil crisis has been brewing for some time, And you look over the past sort of 50 years, there are oil crises, and they become more and more frequent. And this one will be solved. This isn't the end of it, but we'll have another one in a few years' time.
Yeah, okay.
And then the distance to the next one will get shorter. And, maybe next time it's not, Russia invading Ukraine. Maybe next time it's
Taiwan.
Some West African nation invading a different West African nation.
But I mean, yeah, so that's business as usual, I suppose.
Yeah.
Yeah, I see what you're saying.
Or Shell invading a West African nation.
Business as usual. Yeah. Although
that didn't mean to call out Shell. Could have been any one of them.
Just an opinion, ladies and gentlemen. Please, we need to throw up a disclaimer. God.
And yeah, I think we're going through a period where a lot of the staple resources we're sort of coming to a halt on, and we're going to have to replace them with other things. And for a lot of the base metals, they can be recycled, which is great. Recycling of metals will be very important in future. It is already.
What I find, depends how long we want this podcast to go for, but what I find interesting is that ultimately it's hard to create something that's sustainable when so much relies on increased profits each year. So the idea of continuously expansive growth, even just in one company, is... and then you have to do what's always right by the shareholder type thing. I feel like that kind of system that's in place is because you can't just keep growing. Like it's not possible unless you go interstellar or something, right? Unless you learn to leave the planet. How do you keep perpetually growing, right?
Well, I mean, I think our entire society is built on a continuous growth model, and I think a change to that would be a whole other discussion for a whole nother day.
You're the one who brought up war. I'm just...
Yeah, absolutely, because they want to keep growing. And, I do think that we will witness more wars of resources across the next 10 years. I think it's an inevitability, unfortunately. We had a relatively low volatility, stable period of global cooperation and growth, relatively, across the last sort of 30 years. And I think, unfortunately...
Yeah, kind of.
We're starting to witness that. We'll probably start to witness that come to a bit of an end.
We've said a lot of controversial stuff in this podcast. I think that we we go back to something.
Yep, we'll come back to something on the market.
I'm going to tell you, if we throw up too much controversy, people are going to think we're wackos, which we are, but we don't want to reveal that completely all at once. I just wanted to kind of thicken these lines a little bit because I respect that they're a bit hard to see. Mm-hmm. The 200 that we kept referencing, just to digress, was the big red line, I think.
That's the big red line at the top there. Yep.
The big blue line is the 100, and the purple down here is the 50. And if you're not particularly used to technical analysis, these are just 3 simple averages to get on. And if you want to know how they work, all you have to do is, ultimately technical analysis or tea leaf reading, as Sam and I like to call it, even though I personally really like it. All you have to do is just go back and look at how the share price interacts with these moving averages to kind of get an idea as to what to expect going forward. that's literally the foundation of technical analysis. So, how was that for a segue? Not a good one, just completely abrupt, like a train going. Yeah.
Yep.
So you can see that we got pretty close to the 200. Then we pulled back. We're settling on the 100 here, and between the two, that's where Sam and I keep saying that we're pretty much at equilibrium, and we're going to need some more data, as Sam said, likely CPI, price-driven data, in order to shift markets again in any kind of meaningful way. You're obviously going to see short-term fluctuations. We might get back down to the 50, but it's the idea of not moving too far away from those moving averages, because that's where the market sees itself as happy in the medium term.
Yep, absolutely. So if we're going to give a prediction, I think Karo's technically slightly more sideways, just for the coming period. And I think fundamentally, I'm a bit more bearish across the next sort of 3 months or so.
There you go. Just to make things extra clear.
Yep. Just to make things extra clear. So you'd be bullish, not bullish, sideways for a couple of weeks, maybe 2 weeks, a week or 2 weeks?
Yeah, I could see us back at 71.50 tomorrow even.
Yep.
I think US futures are actually going really hard right now in the green.
Another bit of German data on the close today.
Thank you, Fatherland. Sehr gut.
Yeah. But I think, I think that's probably a pretty good place to wrap it up. Technically sideways to bullish in the short term. Fundamentally, it's probably a bit more bearish in the slightly longer term.
Yeah, for sure. I think so. If we're wrong, we're wrong. We'll probably have a different opinion next week. Mm-hmm. I don't know.
Absolutely. And, once again, that's probably how quickly markets are changing at the moment. It's been a crazy year for markets.
Every year's a crazy year. Every year's a crazy year. I don't think
so. I think coming out of COVID, we had nice, fairly stable trends, fairly stable growth. Our market a little less so than America's, but you can draw, a nice long trend line on the S&P.
Fair enough. I agree that maybe I just went insane from lockdown. I don't know. I'm a pretty social dude, but maybe. But it felt like last year was crazy as well with all the sideways movement.
And then 2022 happened.
2022.
It's a bit more volatile.
Yeah. Yeah.
All right. I think we wrap it up there.
Thanks for listening, guys.
Yeah. Leave us a comment. Give us a like. Give us a subscribe. And we'll catch you in the next one.
Yep. Comment on the close.